Hello and warm welcome to another round of monthly macro and market wrap-up, where we discuss few relevant developments over the month gone by, that is April 2023. Global and Indian equities managed to close in the positive. Stocks and bonds had a slight disconnect, wherein bond yields fell, reflecting greater concerns on growth. So let's dig more to understand things better. For one, banking conditions stabilized in April. US authorities managed to backstop deposits and prevent contagion, though the entire episode could tighten credit conditions in the US as banks focus on their balance sheet. Second, we also see higher rates impacting the US commercial real estate and startups. US FOMC is yet to meet for their May policy decision at the time of the recording. There is a consensus on an additional hike, but guidance will be critical to watch. Base effect and past tightenings are leading to lower inflation, though 2% inflation target may still be far-fetched. US activity data is mixed. Retail sales and industrial production had contracted. Job data is mixed, where non-farm payroll continues to be positive, but job openings moderate and initial jobless claims moved up. Earnings outcome have also been pretty decent. Clearly, data doesn't point to recession as yet, but we cannot ignore the aggressive tightening that has happened this far. Interest rate matters and there is a tremendous value in yield curve. We are still in the camp that recession will come by in the US and that will call for both earnings and multiples correction. Similar story applies for India. FY24 earnings expectation could be tested depending on global growth trajectory. While valuations have corrected, some downward adjustment may still be due. To sum up, we continue to think of 2023 as a year of adjustment in Indian equities, even as longer term trends favor an investment-led earnings cycle in India. Commodity prices rose a bit in April. Oil rose with OPEC production cuts. Grain, precious metal and few other metal prices also rose during the month, though natural gas, copper and iron ore prices fell. China's consumption-led recovery has been less supportive of metals demand than previous mainland upswings. Property sector is still weak in China. There's a lift-off on the services side, but production side isn't that great. Thus, limited positive impact on global growth. The recent global banking ructions have supported gold prices through an increase in safe haven demand. A weaker USD through April and the lower US interest rates have also supported gold. The outlook for the US Fed continues to be a key driver of gold prices. We have been positive on Indian fixed income assets for a while now and continues to stay so. Some of the reasons were well anticipated earlier and some are new positive development. First, RBI paused in April policy. Likely, rate hiking cycle has ended in India, which is a strong positive signal for fixed income assets, even if rate cuts are far away. The second reason, which is somewhat interrelated, is moderation in India's inflation. Given moderating global growth, commodity prices should stay capped in 2023. This will drive moderation in wholesale prices and consequently retail inflation in India. We expect near 5% CPI inflation in FY24. But for the food risks, numbers could have been softer, and this improves inflation-adjusted returns. The third helping factor is our outlook on Indian rupee. Dollar, as measured by DXY, has softened 10% since the peak of September 2022. It could weaken further with an end to monetary tightening by the US and prospects of relative growth underperformance by the US in later half of 2023. We expect rupee to appreciate to 79 to 80 against US dollar 6 to 12 months ahead. An added reason is a strong growth in services receipts, which improves the current account dynamics for India. If it were to sustain, it could significantly allay the external account concerns for India. Positive current account development could also shift the FII sentiments in India's favor and offset the relative concerning outlook on external commercial borrowing inflow. As such, we change our forecast from expecting a balance of payment deficit to a neutral balance of payment for FY24, implying that external account related contraction to rupee liquidity may be very negligible in FY24. GST collection has seen a healthy 12% YOY growth in April. That said, fiscal angle plays greater prominence in second half of the year when there is a better visibility on hits and misses to the budgeted goals. Given the 40 basis point rally in GSEC space, valuation has turned neutral compared to equity and its own history. As such, the next trigger for fixed income rally could come from factors driving any change in the policy rate outlook. We have seen 10-year GSEC converge to the ongoing repo rate when rate cuts look imminent. Signing off for this month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.